I'm very happy to be with such esteemed co-panelists. So, Matt, I'll hand over to you to introduce yourself.
Thanks. I haven't been called esteemed in ages, but that's a good start. So, hi everybody. My name's Matt Bullivant. I am Director of ESG Strategy at OakNorth, which basically means if it's got an E, an S, or a G in it, it falls under my remit in terms of internal processes and external facing things. OakNorth are a neobank. We were founded in 2015, and we're a commercial lender in the UK. So we've lent over $9.5 billion to date to SME and growth businesses across the UK. Being a FinTech, we are backed by our own SaaS solution, which is a forward-looking credit intelligence software, which we also license to other banks. And a big part of that is geared to tackling measurement of transitional climate risk for commercial lending. So that's us.
Great, thank you. Dunstan?
Yeah. Hi there, I'm Dunstan. So I work at Goldman and a sort of cross-divisional engineering function to, with the aim really of encouraging people to share more data and analytics across the ESG space, and doing that by providing sort of some shared technology and quant skills together as sort of an engineering package.
Very interesting. Patrick?
Thank you. I'm Patrick Woodward-Eber. I'm the CEO at Util, and we're a fintech company. We're in the data space, and what we do is we use a gigantic evidence base of academic and scientific journal articles. We use AI on that gigantic evidence base to understand whether companies are essentially making the world better or worse through the products and services that they sell.
And hi, I'm Johnny Mattimore. I'm Head of Risk and Sustainable Finance at First Derivative. My background is 15 years banking, 15 years hedge, and in the last few years I've been working with colleagues in both risk modelling for revaluation using all of this new data and all of the regulatory frameworks around that, which I work with my colleague Chris Owers, who is here, who's also an ex-banker. And our firm is a combination of consulting and product specialisation. We have a very large number of fintech partners we work with. Some of them are here. Finergo is one of them. Fathom, Airbus is in the audience. And we've probably got 20 or 30 major fintech firms we work with. And we have very large go-to-market plans with them. And we're often a channel to the very large banks for these highly specialized fintech firms. Thank you.
Great. So, we have a very diverse panel here. We've got neobanks, we've got traditional banks, we've got startups, we've got consulting. So, very, very exciting. I just wanted to remind the audience, we are taking questions throughout the panel discussion. So, please submit your questions via the Brella app from the homepage. Click top left and then select Q&A. So, it would be great to have engagement throughout the discussion. So let's understand a little bit about the organizational priorities, both operational and strategic, that you're looking at in terms of ESG data. So, Matt, why don't you kick us off on that?
Sure. So we are a 7-year-old business. So for us, we are starting from scratch here in terms of ESG strategy. And ESG, this has been the bucket that anything non-financial has been lobbed into over the last 10 years. So if you're starting from scratch, you kind of need to get your head around, actually, what are our priorities? You're not going to do all of it at once. So a lot of our kind of strategic thinking is actually where are the most material areas for us to focus on? Part of that is to do with the nature of our customer base. A lot of what we finance is, say, for example, in the built environment. And if we combine that with the fact that we've got our own climate product out there and the built environment contributes 40% of the world's emissions, it puts climate up near the top of our agenda just internally, regardless of the world's position on that being, one of the challenges of our time. So that's part of it. In terms of strategic focus, so our founders a couple of years ago were of the mindset that climate change is too big a deal to ignore, and we have to do something about it. And so we've set ourselves a 2035 net zero target, which for a bank, when that includes all of our financed emissions, is a fairly strong place to start. So from a strategic priority point of view, it's a case of figuring out how we get there. And I guess from a data perspective in particular, We lend to private businesses. We lend to not necessarily tiny of SMEs. They're more M than S. These are multi-million pound turnover businesses, but they are still small. And they're not caught by regulation, so they don't have to disclose anything. And they're a lot earlier on the journey even than us, frankly. So I guess the easy answer to one of the big strategic challenges around data is that there is no data. But that's a bit of a cop-out, because the reality is that there is data. It's just in the wrong place, with the wrong people, or simply not accessible to financial institutions. So trying to unlock that as to, do we come up with a workaround, or do we find ways of accessing that data, and what sort of kind of collaboration across the industry and the industries that we serve is part of that strategic priority in terms of tackling our primary ESG priorities.
And I saw lots of heads nodding there, so I think it's something that resonates with everyone, regardless of the industry itself as well. So Dunstan, I know Goldman is obviously in a different space, so it would be great to understand what are your kind of organizational and strategic priorities for ESG data.
Well, I think so. Obviously, we've got pockets of the bank that are doing a huge amount, and other parts that are loving to talk about it and doing less with data, perhaps. And we see a huge opportunity increasing the amount of sharing we do. We see a lot of clients very interested in investment bank advisory, in knowing how the asset management arm would see their different actions and potential things they might do. But as you do that, it's one thing to talk about it, it's another to do it with the same data, the same measures, the same analytics. And I think that's where we, start to see that consolidation of and sharing from experts to each other that we can really help. And coming at it from a slightly derivatives background, that the data can be quite complex, but the more eyes you have on the same data, the better, and the more that you empower end users to really investigate and use data, not just assume what they know, and to drive their decisions, the better.
Excellent. And Patrick, it would be great to understand what Util is thinking about as well.
Well, exactly. And actually, it's very interesting that Dunstan, you should say what you did, because it's very similar to our own approach, which is that over the past couple of years, what we focused on is really making sure that we provide a kind of scientific, call it a sort of foundational level of evidence connecting the way in which companies have an effect on the world in various different ways. And so that evidence backs the data that comes out. We've mapped that from publicly listed companies through to the UN Sustainable Development Goals. What will happen next is applying that exact same process of mapping evidence through to different types of securities. That'll be fixed income securities next. After that, it'll be private companies, etc. So that effectively we have the same underlying evidence kind of underpinning various different ways of looking at companies, and that gets more eyes on the same data, and it kind of ultimately, I think, gets towards some of that transparency and helps others use the same thing. So very similar.
And Johnny, I know you do a bit of, the firm does consulting, but also products. So it would be great to understand, what are your priorities as well for ESG data?
So the main priority is how to enrich existing financial data, and to ask the questions, what do you want to enrich it with and why? So one could be a valuation question, the other could be a mandatory disclosure on emissions on mortgage portfolios and physical risk on mortgage portfolios, and then everything in between. What we've found is that firms are increasingly realizing a huge amount of this information is unlikely to be proprietary. Open source is really important. Collaboration is the only way. Point solutions are pointless unless they're integrated together, because all you end up is creating another application stack, which is an absolute nightmare for every financial institution. And the speed with which you can integrate this data, enrich financial data, and then scale it so that it can be consumed universally across lines of business and group functions. And when you do that, then you're pretty much replicating, the golden dream of most financial institutions, to have a pretty seamless way of getting access to business-critical decision-making information, which actually you can access confidently because it's of high quality. Now, banks have struggled with that forever, but this is pretty much a clean sheet. We work with open source climate. We've created an open source sustainable finance taxonomy group of large tech firms, And all of these things are collaborative efforts. So everything we're doing is collaborative. And when we go to firms, we might not be selling what we're capable of. We might actually simply be introducing somebody who's going to solve the bank's problem. And that's how we keep the relationships going, and eventually we all make money. But to think you can be the sole arbiter of solving a bank's problem, you might as well leave the room.
And I'm actually going to stay with you on that, because it would be, given your interactions with the different banks and, you know, given your own experiences on, you know, taking the firm to the sustainable path, what are the persistent problems that continue to exist? And given the dynamic nature of ESG data, what are the new challenges we're experiencing, you know, as the scope and breadth of the availability expands, the, you know, providers increase? So yeah, just give us a bit of idea on that.
Just so you know, this isn't like an opinion or anecdotal. We do work with 25 of the 30 GSIBs. We also work with probably another 100 financial firms. So we've done a really large sampling of clients. I don't live in a bubble. I talk to clients literally every day of the week, as do my colleagues, and we've amassed a huge knowledge base on this. And the universal approach to all of this is not to try to put the data in any single data lakes, and to maintain a really agile way of enhancing the data going forward, because we know it's Swiss cheese today. So every time there's better data, we need a really fast way of updating it. If we choose a particular vendor, we need to monitor their quality assurance. If it degrades, we need to be able to switch in really fast alternative providers. So, you know, not getting into technology, but the concept of a data fabric, which is highly agile, highly dynamic, which can integrate both data and applications for derived data, is absolutely the top of the problems. How do you do that in a lean way, which is fast, scalable, and also at the lowest cost? And this concept of collaboration for shared services, rather than just having something which is highly commoditized just for your own firm, is gaining enormous traction. In fact, Goldman is a lead founder of OS Climate.
Absolutely, OS Climate's very exciting to us, and even some of that sort of data fabric bits where we sort of worked on providing data modeling tools to help people understand different data sources and how they connect together. We open source through the same sort of FinOS organization, and originally for sort of other regulatory reporting, but it's part of that fabric.
And repurposing that reg data, because we all know reg is a cost generally, but if we approach this, and this is what Chris and I have been doing, every time we try and find data, we try and ensure that if it's used in reg reporting, it has a dual purpose to be used in the line of business or a group function. And then we create business value.
And Matt, I'm going to actually come to you, because you're obviously looking at building your own platform. So you have been in the midst of some of these data challenges, and you know, some of the things we talked about before today's panel was this idea of collecting data for the sake of it, or because it's there. So it would be great to get your views on, you know, how are you kind of getting around that issue, which is persistent in financial services often.
Yeah, I think we're really good in financial services at collecting data for the sake of it. It's something that we've perfected over many years now. I think that's fine when there's a lot of data out there. And I think one of the perspectives that we kind of have, given the nature of the organizations we work with as customers for our banking business, is because there isn't readily available data, it's really important to think about why you're asking the questions you are to gather the data. It's got to be decision useful, because you can otherwise waste an awful lot of time trying to collect data, and then you discover you've got it and it doesn't tell you anything. I mean, I'll give you an example of that. We actually took an approach for the lending side of our business to say, well, you know what, there isn't a lot of obvious available data, so let's just ask them. Let's just ask our customers. So we asked all of them a series of questions. Do you have an ESG strategy? Do you have someone responsible for climate change? Have you set a net zero target? And pretty much all of them came back and said no to all of those questions, which tells you something about the scale of the problem, but can you do anything with that? Is that decision useful information? No, because it wasn't the right set of questions. So I think, you know, both from the basic level and the more sophisticated end of things, it's not just about collecting the data. It's why are you asking the question? Because if you have a portfolio of businesses and you're, say, trying to collect carbon emissions, if you've got, for example, a large coal, oil and gas book, do you need to know the carbon footprint of that book to know that you need to do something about it? Probably not. If you want to know the carbon footprint, that's got to be for some purpose. So it's just when you're designing technology, when you're thinking about questions that you might be asking or data sources that you're trying to seek out, why? And this happens a lot with ESG products out there as well that are geared a lot of the time for just production of data. You've got to think about the end user of that and what they're going to do with it, not just there's a gap in the data set, so let's fill it. And I think it is a habitual problem, but we have an opportunity to be a little bit more creative about how we go about data.
Patrick, I can see you.
I was going to say it's so interesting because we're on the other side of this table all the time, which is that we're the data provider. We fill a very specific gap. I like to think we're doing it for very specific reasons, and our clients come to us for this exact. They sort of, in this sense, they know that they are looking for something. But I do hear echoes of what we see all the time, which is that we do find that many times there's a lot of uncertainty over exactly what to do with which bits of data, how does the data all fit together. We designed our data from the very, very beginning to sit alongside existing data and to contextualize it better. Simply, it's not exactly just filling a gap. It actually makes other data more informative than it would be otherwise. And that was our whole kind of purpose from the beginning. So it's very interesting to hear the three of you talk from the other side of the table about this exact issue, because we see it all the time. And we encounter people at very, very different stages on this journey. And some of them do, frankly, come and they say, we know we have to do something, we have no idea what it is. And the extent to which we, on the data side, are actually participating in this type of kind of consultative discussion is quite surprising.
Yeah, I mean, it's interesting because the question isn't what are the challenges with the data. The question is, what question do you want the data to answer? And then go find the data that'll help you answer that question and solve those contextualized problems, which is a very different way to look at it. And I think we often get caught into there's gaps in the data, we need to fix that, but never answering for what and so what, which is great. So in order to kind of harness and make use of the ESG data, what kind of skills and tools and technologies do you think are needed? Maybe Patrick, we'll start with you on that one.
Yeah, and I would say there's a range. Obviously, with us, we're a tech company, so we're very engineering heavy. We have very specific needs in terms of engineering needs. We have machine learning engineers, we have data engineers, etc. And so obviously, to a certain degree, I think it depends a lot on the exact purposes that you're looking at. So you need different types of expertise. Having said that, I also think you can think of it as like a mathematical spectrum. There are people with math PhDs and there are people who are numerate, and we should all be numerate. And I think that technologically is where we need to end up. We need to have a sense that we actually understand what these technologies are fundamentally doing, and then sort of work from there. And then, obviously there's greater levels of expertise that are needed in order to do some more specialized applications. But I think if there's one area where I think that there's a kind of major skills gap, it is in this kind of sense of call it technological literacy. I think that's really important.
And do you think kind of machine learning and AI, those conversations help address that gap, or do we think we still need to understand what those mean before we can use them in the right way?
Yeah, I think, well, we're on our way. I think that's the main thing. I think the difficulty with AI and machine learning is, again, that there's a spectrum. There's statistics at one end, and then there's things like large language models at the other end that are immensely complicated, sort of neural networks and all of these different things. And I think it is very, very easy to suddenly say, well, AI is one kind of monolithic thing to either be enthusiastic about or to worry about, depending on how you see it. But there is a vast spectrum of things that we already do that use AI. And even something as basic as the spam filter on your email is already doing the things that are being applied in all kinds of other ways. So these are they're already with us, and that's what I mean by sort of this idea of technological literacy. Is I think we don't really know what to worry about, and we don't really know what to be excited about until we have this kind of foundational grasp of where on the spectrum the technology really sits.
Johnny, what do you think about that?
again, going back to what question you're asking. So I'll use the example of banking. It seems to be the focus of government policy levers, but it impacts asset managers and insurers in exactly the same way. But banking is only about three things as far as the regulator and the bank executive is concerned, and it's solvency at Pillar 1, buffer capital to reinforce solvency at Pillar 2, and if you've got risks which aren't in either of those pillars, Pillar 3. So if you look at the way the regulator's coming at this, and the EU is the leader, they came with a Pillar 3 requirement to disclose carbon emissions and to categorize them into different buckets for assets and also the collateral for the lending assets. Now, why do they do that? They're doing that because they haven't got a handle on the data. Once they've got a handle on the data, it'll be Swiss cheese again, but it doesn't matter. It's the first best cut you can get. So why are they gathering this? Because they want to know how severe is the intensity of carbon funding, financing in the banking system. And then they're going to start looking at, should you have some temporary increase in buffers? Now, for anybody who knows the way in which a bank works, it's return on equity, return on capital. If you've got to increase your capital, your competitive position is crushed in the market. So this gets the attention of everybody by going after Pillar 3. So hopefully then you start to address Pillar 2. But ultimately you've got to get to Pillar 1. And what is that? It is, how do you bake this new data into capital models? Because if this data is irrelevant to how you price a loan, then there's no point in getting it. But if you take something like the carbon emissions on a borrower and you want to use that as your first ever new data point to proxy, then you need to have a framework for a revaluation of that asset. It doesn't matter if it's mortgages, bonds, or commercial lending. You have to now start thinking about how does that impair or enhance the value of that asset. We coined the term the big green short. We all know what the big short is. But here's the big green short. If you own a bunch of mortgages in Tampa, Florida, and you haven't got the proper flood risk, for example, you really are not going to know the value of those assets in 5 years. And if the insurers pull their insurance in 1 year, so that's a physical risk example. The same is true on carbon emissions. There are whole industries, we were talking earlier about, the entire steel industry in the US is at risk of bankruptcy if there are ever carbon taxes or there's a forced decarbonisation of the domestic steel industry. These are not trivial things. They have massive societal and political ramifications. And it also has massive ramifications for the capital of banks.
You touched on quite a few different use cases, tangible use cases from a solvency and a business perspective. But one of the audience question is really, how can we achieve industry-wide approach to ESG data strategy so that it's reliable, plausible, explainable, and consistent? The risk you see, with the mortgages in Tampa, Florida, might be very different to, somebody else using a different set of data. So it would be great to understand if we have thoughts on that. Maybe Matt, I'll start with you.
Yeah, I think part of the problem is everybody's going after this in their own way. It's a bit of a trade-off because quite often the industry kind of looks for guidance, and we talk about policy and we talk about regulation for frameworks, for guardrails as to how to go about things. And the danger is that while waiting for that, nobody does anything. But on the flip side, it means that if there's no direction, then everybody goes about it their own way. I think part of the answer is that end use point in terms of saying why are you trying to do this and what are the objectives? Because if everybody thinks about the objectives, actually a lot of the time across financial institutions, those objectives are consistent. It's just that the counterparties they're dealing with are where the variation is. I think part of the other kind of side of things is just transparency. I will advocate transparency all day long because everybody worries about greenwashing and the like. If you have been very clear about how you've gone about things and where you've sourced your data and the limitations in that and the assumptions that you've made, people might challenge that, but they can't accuse you of greenwashing or trying to hide something because you've been open about it. And I don't think we're very good at that in financial services. We're quite protectionist about how we go about things. And I think the industry, both from a collaborative point of view in terms of finding the right solutions, needs to come together a little bit more than we have done. But I also think we need to look outside of our own industry and look at not just us and our own regulators, but the industries that we serve and the ESG industry, if that is a thing, to try and find the right answer. And things are happening. Certainly from a regulatory point of view, there's a lot of things kind of coalescing now. We're looking at kind of the ISSB coming into play, which is trying to bring together standards and frameworks that have diverged for a number of years to kind of standardize those, formalize those, make them, the international baseline that is sufficiently detailed that it can't be open to too much interpretation. So it's coming, but we're not quite there yet.
And I think along the same lines, another audience question, please do keep them coming. Very, very interesting. So currently, I last read that there are about 1,200 data providers in the market and probably growing, 10 a day, I would say. Some of them are quite undifferentiated. Some of them are very niche. So how would you go about, ensuring that you're picking the right partner to, complete that data ecosystem that you're building out? Maybe Dunstan, would be good to hear your thoughts on that.
Happy to try and talk to that. So I think there's a part of what we're trying to do is get data as quickly as possible to people who are making decisions, and so that they're asking a real question that they've got to make that decision on. And so how do we get them able to spot interesting providers and test things out quickly? And there can be quite a lot of challenges in those routes of the data provider will give you data, but then you've got to join it to an awful lot of other stuff and make it easy enough to use. And then should it be useful, how do you stop that just being a vital spreadsheet that takes, so much risk in its own right, and you have a quick path through to production? And so I think some of that data pipelining process is super important to think about. And then that helps you scale out to use more providers, and particularly as we go to biodiversity or something, the range of different data in ESG, the number of different formats is huge. And so providing things like data catalogs and other things in a very strong way is important to handle that breadth. But also I feel we haven't, if we look in the market side, we're very used to having many brokers giving us different prices. What do we do? Or we take averages and we drop top and bottom, and we use it to drive data quality through variety. And so having the comfort of scaling out to more providers and being able to switch if one of them increases prices or something, that is part of what data strategy needs to encourage and encompass. That's all.
Go ahead.
I was just going to say, I'm on the other side of that exact table, which is awesome. And I think, because the question is sort of how do you choose the right data provider? And obviously I've got a vested interest because I want to be the one that gets chosen for many, many clients, but not all of them, because we're not always a good fit. So I think what that tells me, at least as a data provider on the other side of the table, and what I would really encourage, if you are on the other side of the table from me, for instance, is ask the challenging questions. I mean, just know where it's coming from. Challenge the transparency. Really dig as hard as you can, and don't take anybody's word for it. Because I think that's where, partly as data provider number 1199, that's where we are differentiated in the beginning. But it's also, I think, it's absolutely imperative. For reasons of data quality, so that you understand when and how you need to switch if you're in that data pipeline, if you make it into that data pipeline, all of those different things. It's absolutely critical, and we always welcome those challenges. We've had, I think we've faced just about any possible question you can have, and I think it's really, we always welcome them for this exact reason, because I think it's really, really important to stand up to those challenges and have data that will actually survive them. I think is really, really critical.
And up until now, we've always talked about ESG and sustainability as kind of separate. There's a team that's doing it. It's a separate data problem. But how would you really integrate ESG data into company culture and make it future-proof, given that it's dynamic? Because if we keep treating it separate, it's not going to bring that transformational change that we need. So maybe, Matt, if you could talk a little bit about how you guys are doing it, would be great to hear.
Yeah, and I think to some extent we have a slight advantage because we are starting from scratch, which has its benefits as well as its challenges. And I think it was mentioned earlier a little bit around the importance of tech literacy. I think there's a real important gap at the moment in terms of ESG literacy as well. And I think that's a case of all teams within your organization need to understand why it's relevant to them. And I don't mean that from a kind of societal point of view. It's not we're doing this because it's a good thing to be doing, or we're doing this because actually it's the top level company strategy, which it needs to be. And I think it was mentioned in the first presentation of the day today that there has to be that message from the top, and that's great. But the bigger the organization, the further the top is from the people who are actually on the ground at the bottom. So I think the key really is that people have to understand why it's relevant to the job they do. And that means that your strategy has to be adaptable and relatable and understandable to anybody, whether you work in finance, whether you work in frontline sales, whether you work in risk, whether you work in reg reporting. I think if you work in ESG, part of your role isn't just to do everything in ESG. I would love to say that I was an expert in risk, reg reporting, debt finance. I'm not. But what I ought to be doing if I'm doing my job properly is ensuring that message is articulated and made relatable to all of the individuals who work in that. And that applies to data as well, because actually there is a push and pull with data sets to have a centralized data set, but that's got to be accessible to all of the users of it, because a lot of the time it's similar data that's being used in different ways by those different functions. The danger is that it ends up being a centralized data set because it's being used just by the ESG team, who do not know how best and how most effectively to use that data if you are deploying it in those functional units.
And Dunstan, I know you are working in that kind of central team that makes data available, so it would be good to understand how through innovation you're driving some of that company cultural change as well.
So I think I'm very much in a central team that sits within the larger organization's data platform, and we're there to help ensure that data is distributed in a similar way to other forms of data, and so that it's easy there, but to help adoption and use the newness of ESG to sort of ramp up and be in that tidy place, and be using it in the most efficient, quick to access, but then safe to build on type ideas. I think the
Okay, that's great. And Patrick, it would be good to understand from a cultural standpoint, a technological standpoint, what conversations are you seeing happen on changing culture?
I think the places, so I see it on two sides. I fully agree. It has to be a kind of organizational priority. It can't be a kind of siloed, separate activity. The clients that we work with who I think do this best, what they have in common is that they don't treat it like a specialized skill. They don't treat it like there is this team that does that one thing, and that team's job is to make other people do it. That's not going to work. But the places that really do it successfully, they call it integration, but it really is there's kind of an osmosis that goes on where it really infuses a lot of these things at the practical level of how does this affect the decisions that I make in my day-to-day job. And when that's really, really clearly articulated, when that's really well structured, when it flows through from upper through middle to sort of lower levels of management, that's where it's the most successful. It's very, very difficult to do because obviously that's a really complex maneuver. But I think when it is successful, it is this idea of it is simply everybody's responsibility and it's part of their job. They understand it and it's technically tied in very tangible ways to their job. I think just saying, oh, it's an organizational priority, or we've got this great team and their job is to tell everybody what to do when it comes to ESG is just sort of doomed to failure.
And even when you bring about that, let's say, cultural change, Johnny, how do you think we'll make it future-proof? Because ESG itself is changing and it's more and more dynamic.
I think it's interesting when people talk about culture. The use of ESG has probably been really helpful for the recent years, but actually we're talking about what finance looks like as a fundamental shift in business practices 5-10 years from now. It would be helpful if we drop that term, in my view, because sustainable finance will become the new normal and it'll become traditional finance. When we integrate this data, it's no different to integrating market data, bond prices, volatility curves, all these things. It'll be part of the same suite. We'll manage it the same way. We'll use the same risk models, and we use the same infrastructure. But what will change culturally is the way people use particular metrics for thematic decisions, and also the way that feeds into derived data. So if you're making a decision on liquidity, you may get concerned that certain assets are going to be less in demand in the future. So it's not going to be eligible collateral. So start thinking about this, in my view, culturally, as exactly the same as today, but we're just augmenting what we do today. Now, some of it will be really difficult, but if you start thinking of it as separate, I hate the fact that I'm head of risk and sustainable finance, and everyone says, Johnny, what are we doing in ESG? And I say, what are you doing in ESG? I don't own it. I've got the nominal title, but actually I work with every unit in our firm. And one of the key things I want to do, we have technology partners in Murex, Calypso, for now, loads of them. What I want to know is, what are those firms doing to add new modules to make sure we can provide the right value add to the users of those technology stacks? Otherwise, we're just a piece of spaghetti on the side of the plate. We're useless.
And you touched on something that, again, it's coming from a couple of the audience questions, which is ratings and metrics for ESG. Now, I think you probably know where I'm going with this. There is no accepted global framework for reporting. So how do we balance that short-term, views versus long-term protection using the data set that is not consistently recognized and, aligned in?
I don't want to steal everyone else's thunder, so I'll be really brief. There are two major issues we're grappling with. One is in climate risk. Those models are adapted meteorological models transformed into economic models. They're very long horizons. They are completely useless to running the business. We run a business today by using counterparty risk in almost every financial services business based on a 3 to 5 year long-term horizon. That's what credit risk ratings are. We currently have a one-to-one mapping from credit risk ratings to counterparty risk. We're now going to augment that set with extra information, call it green risk ratings or whatever. But ultimately, the new counterparty risk framework is going to get redefined. So how you do that within the right time frame is really challenging, because climate risk models can't do that. NGFS has just come out and they want submissions for macroeconomic models for a 3 to 5 year horizon. But actually we're in the business of microeconomic models of valuing individual lending policies. So we need that bottom up of a microeconomic framework. Now we do that already with internal credit ratings. Now, whether or not you like it or not, that is the single most important end game for anybody selling anything into a bank. And the second thing I would say about ESG ratings, or ESG risk scores, the generic term scores, be very wary. They are nothing of the sort. Risk requires two things. You need to be able to simulate a range of future returns, gains and losses, a probability distribution. And from that, you then need to backtest it. There is no ESG provider in the world today that provides those two qualities to an ESG score. Therefore, they're simply thematic aggregations of what is quite a random data set. Now, that random data set may actually have real value for us, but aggregating it as ESG is of no value. So the underlying data that ESG has led to a proliferation of, that's the data set we need to mine and extract the value to answer the question we're asking.
Sorry, Patrick, go ahead.
I was going to say, I couldn't resist. I got so absorbed in your answer. But also, this is part, and I will say this because it personally fascinates me, but just to address your initial question, I think the way to navigate it is precisely to provide more detail, because ultimately that's where investors and other kind of financial market participants can start to express the wide variety of their preferences. The issue is that if you only have, 5 letters to choose from, there aren't that many ways you can express your investor preference. There's just, you don't have that many choices. And so what you really need is a very, very detailed way to understand and then obviously make decisions based on that underlying data. And so to your point, one of the things that we have embarked on as a company right from the very beginning is, as I mentioned, we map to the UN Sustainable Development Goals. Rather than choosing goals, and there are 17 of them, again, a limited number, what we do is we map to an underlying universe of thousands of different concepts that roll up into different frameworks. And so that allows us to go to an increasing level of detail. And in case it's reassuring to Johnny, what we hear from clients all the time is, can you tell me the extra levels of detail, please, so that I can understand better and make more kind of focused and targeted decisions. So we see that all the time. Sorry to jump in. I knew you were going to turn it over to.
No, that's really helpful, Patrick. Actually, because it resonates quite a lot. Because from our point of view, the way we go about climate risk, and certainly thinking about transitional risk, and the way our software deals with that is to take a much more granular subsector view of what's going on with your borrowers, because things like climate risk, you need to look that one step further than just the company financials of the business that you're lending to, because we've got to think about their value chain, their supply chain, what might happen to those integral parts of their business model that you just can't see from the traditional financials that we'd pick up. The other part of the problem there as well with climate risk is regardless of the time frame you're looking at, actually there is no precedent. There is no benchmark to look at from historic data a lot of the time. So you have to think about potential levers, and that even some of that is applicable over a 3 to 5 year time horizon, frankly. And the other piece that I would say about this is that context is really important. You could have an ESG rating that says, oh, that's a terrible business because it's got a much higher carbon footprint than this one next door. But well, hey, what if it's halved its carbon footprint in the last 3 years and has a plan to continue to do so over the next 5, whereas the business next door is going in the opposite direction? You don't know because you caught a snapshot in time. So think about context in terms of utility of that data. And my last kind of philosophical point around actually a lot of the models taking long-term views, 10, 20, 30 years for climate risk modeling, which is just not the sort of turnover that a lot of banks operate under, is we still have to have one eye on that. And the reason I say that is, I forget now, I think it was someone like Oscar Wilde who got asked, how did you become bankrupt? Very slowly and then very suddenly. And I think we just have to have that awareness when we're kind of just in the day-to-day that actually climate and ESG is presenting that as a concern which is new for us as banks.
That's very insightful. I like the Oscar Wilde comment. I'm going to use that very, very often.
Check it first.
Yeah. Well, I'll say I heard it. So, Dunstan, any final thoughts?
Yeah, lineage tracking,
yes.
I think, exactly, of quotes. But I mean, a variety of data, absolutely important. But as vendors, we love vendors that have fast update times, can give us model docs, can show us that. We're not going to go and replicate. We want to buy it, but we only want to buy it if you're not doing it manually and coming up with number at the end. Yeah.
Great. Well, we learned something about Oscar Wilde, potentially. But I think it was great because what we really said is that to define a future-proof ESG strategy, we need to understand the context of the data rather than just embark on gathering more and more data, and look at tech literacy a little bit differently. But ultimately, we need to change the culture on sustainability to make it sustainable. And it shouldn't be ESG and sustainability. It should be integrated in the fabric of the organization to make it a part of the tapestry. And with that, I'd like to thank my wonderful co-panelists for this insightful discussion. Thanks very much.